Welcome to this explainer. Today, we're giving you, the passive investor, absolute X-ray vision into multifamily real estate deals by mastering one completely crucial metric. If you want to evaluate property deals effectively and stop relying purely on an operator's promises, well, you're exactly in the right place.
Here's the roadmap for today. We'll cover the one vital number, decode the formula, look at the mechanics of property value, trace NOI across the deal lifecycle, and wrap up with exactly how to vet an operator's math. Let's get right into it.
Starting off with Section 1, the one vital number.
So what is net operating income, or NOI? Simply put, it's the income a property produces from its operations after operating expenses are paid, but before debt service, depreciation, and income taxes. The absolute crucial takeaway here is that NOI measures a property's pure operational performance. It doesn't care how the building is financed. It completely strips away the mortgage terms and looks right at the actual heartbeat of the property itself.
And that's exactly why NOI acts as your ultimate lie detector test. As our source puts it, it's the cleanest signal of whether a property is producing value on its own merits. You're not getting distracted by clever financing tricks. You are looking at raw, operational reality.
Moving to Section 2, decoding the NOI formula.
Let's unpack the revenue side first. You really need to understand the massive difference between gross potential rent and effective gross income. Gross potential rent, that's theoretical. It's the dream scenario where the property is at 100% occupancy with zero concessions. But effective gross income, that's reality. It accounts for vacancies and unpaid rent. So when an operator hands you a pro forma, remember, NOI is based on the reality of collected effective gross income, definitely not the fantasy illusion of gross potential rent.
But keep in mind, revenue isn't just base rent. A really savvy operator is always hunting for untapped ancillary revenue streams. We're talking parking fees, storage unit rentals, pet fees, laundry, package lockers, and utility billing programs, often called RUBS. When you're looking at an underperforming asset, this list right here is exactly where the hidden treasure and massive upside lives.
Now, on the other side of the formula, we subtract operating expenses. These are the daily, ground-level costs of running the property. Things like property management fees, taxes, insurance, maintenance, landscaping, and admin costs. Notice what is not on this list: the mortgage payment. These are purely operational costs. And bringing down an elevated operating expense ratio, that's a massive opportunity for a skilled operator to instantly boost the bottom line.
Okay, Section 3, the mechanics of property value.
Let's look at the math with a super clean hypothetical for a 50-unit property. Say we have $600,000 in total revenue and $240,000 in operating expenses. That leaves your baseline NOI at exactly $360,000. That's our starting line.
So, what's this building actually worth? Since commercial value equals NOI divided by the capitalization rate, or cap rate, applying a 6% market cap rate to that income gives us a baseline property value of $6 million. The cap rate is simply reflecting the return an investor expects in that specific market.
Now, watch what happens when an operator actually executes their plan. They raise rents, add ancillary income, and trim the fat on expenses. Revenue jumps to $660,000. Expenses drop to $228,000. Through sheer management skill, they've boosted the NOI to $432,000.
Keeping that exact same 6% cap rate, we divide our new NOI of $432,000 by 0.06. Suddenly, the revised value of our property leaps to $7.2 million.
And here's the absolute punchline. That is $1.2 million in property value created purely through operational execution. Not market luck, not interest rate changes dropping from the sky. This is the staggering power of forced appreciation. It proves, without a doubt, that an operator's ability to move the NOI is the central variable in your entire investment thesis.
Moving on to Section 4, NOI across the deal lifecycle.
Here's what a standard timeline looks like for a multifamily investment. We start at day 0, which is acquisition. Then we have years 1 through 5 representing the operational hold. And finally, year 5 and beyond for disposition or refinance. Across this hold period, an operator's relationship with NOI totally shifts, from underwriting an opportunity initially to active dashboard tracking to ultimately cashing out.
As a passive investor, your job is to realize exactly how this works. At acquisition, NOI defines the opportunity. It's the gap between the current management and the future potential. During the hold, It's the daily dashboard measuring real-world execution. And at disposition, it dictates your returns. Simply put, a higher NOI means a higher appraised value and a much better payout for you.
And finally, Section 5, vetting the operator's math. Let's put this into practice.
First up, you have to ask, what is the current NOI versus the projected stabilized NOI? You must force operators to clearly separate what the property is generating today from what they are promising it will generate tomorrow. The spread between these two numbers, that is the exact size of the risk you are underwriting.
Next, you need to dig into the operational assumptions driving that projected stabilized NOI. For instance, if they're assuming 100% occupancy with zero concessions to hit their target, that is a massive red flag. Their math just isn't grounded in reality. Real buildings have turnover. Real buildings break down and have maintenance issues. Make absolutely sure their projections live in the real world.
Third, look closely at the going-in and exit cap rates and ask how conservative they actually are. A serious operator is going to be completely transparent about these variables. They won't hide behind vague projections that just push unmapped risk onto you. If an operator assumes the market cap rate will magically improve just to make their exit numbers look good, well, they're hoping, not planning.
Which brings us to a final thought. Are the operators you're evaluating treating NOI as a true operating language, or is it just a slick marketing buzzword? Because once you speak the language of NOI fluently, you stop just crossing your fingers hoping for returns, and you start actively verifying exactly how the value will be delivered. You don't just become more informed, you become an incredibly effective partner. So the next time you get handed a deal package, ask yourself, does this math tell a story of hope or a story of execution?